We're analyzing Fastenal, stock ticker FAST, FAST, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Fastenal. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Fastenal for your portfolio. Before we get into these valuable metrics, let's understand Fastenal's stock performance. Now, Fastenal trades for $54.01 per share. In the last year, their stock price is down 5.5%. Even though they're down, they're outperforming the S&P 500. In the last 5 years, Fastenal is compounding their stock price at 16% annually. In the last 10 years, their stock price is compounding at just under 9% annually. Going back prior to the global financial crisis, in the last 18 years, Fastenal stock price has compounded at 11.5% annually. Currently, Fastenal pays a 2.44% dividend yield. This large dividend and their average dividend throughout this time is in addition to these compounded annual returns. Fastenal trades just $3 below their 52-week high. The company's up $10 from their 52-week low. A little over 2% of their shares are sold short. Fastenal is a big business. They have a nearly $31 billion market cap. But the burning question is, why should we be paying close attention to Fastenal? Fastenal opened its first fastener store in 1967 in Winona, Minnesota. Since then, Fastenal has greatly expanded its footprint as well as its products and services. Today, Fastenal serves its 400,000 active customers through approximately 1,600 branches, over 1,600 on-site locations, and 14 distribution centers. Since 1993, the company has added other product categories, but fasteners remain its largest category at about 30 to 35% of sales. Fastenal also offers customers supply chain solutions, such as vending and vendor-managed inventory. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. Over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns will be captured here by return on capital. The average publicly listed business earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in some margin of safety based off the overall quality of the business. Fastenal earns huge returns on capital in all 5 of these years. All of them have been above 30%. And averaged out, Fastenal has earned about 33.5% returns on capital in a given year over this time. These returns are nearly 4.5 times better than those of a typical business. This is a huge check on metric number 1. Metric number 2, we're looking at the high-level growth of the business. We're looking for revenue, net income, and free cash flow growth in the last 5 years. This metric is all or nothing. All 3 of these have to be up for this to be a check. During this time, Fastenal has grown their revenues by 44%, their earnings have grown by 48%, and their free cash flows have increased by 86%. This is strong growth across the board here. This is another check on metric number 2. It's great to see that their free cash flows are leading their growth. Free cash flow is the lifeblood of any business. Free cash flow can be used to pay dividends, buy back shares, reinvest back in the business, make acquisitions, or pay down debt. Ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business will be worth. We'll be using that exact method later in our video to come to an estimate of Fastenal's fair intrinsic value, so stay tuned. Metric number 3, we're looking for earnings per share growth in the last 5 years. This takes the perspective of an individual shareholder in the company. Fastenal's earnings have grown by 48% over this time, and the company has had just very minimal shareholder dilution, coming in at less than 0.5% of their overall shares. With their earnings growth, this is a check on metric number 3, as Fastenal is increasing their value per share. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. This is similar to our previous metric for almost the same reasons, with strong free cash flow growth and just very minimal shareholder dilution. This has led to Fastenal producing strong free cash flow per share growth. This is another check on metric number 4. We're perfect through our first 4 metrics on the business. But there's still one vital piece missing. You might think nailing high returns on capital and having great growth is the key, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt. During economic downturns, it's overly levered businesses that are at the greatest risk of poor outcomes. In metric number 5, we want Fastenal's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow the company has produced in their last 5 years. Fastenal ended their most recent fiscal year with $500 $472 million in net debt. Currently, they've reduced this and they have $408 million in net debt. In the last 5 years, the company has produced more than $3.4 billion worth of free cash flow. This is a huge amount compared to their net debt position. A very big check here on metric number 5 means that we're perfect through our first 5 metrics. Does Fastenal have what it takes to be a select 6 stock? We'll find out right after we cover our bonus metric. As our bonus, we're looking at Fastenal's dividend profile. Right now, Fastenal pays a big 2.44% dividend yield. This is higher than the dividend yield from an S&P 500 ETF. However, people make mistakes all the time by blindly chasing dividends, so it's important to stop and look at the underlying fundamentals of a business to see if their dividends are supported. Fastenal has supported their dividends in 4 of these last 5 years. The company issued a special dividend in 2020, which with their normal dividends was supported by their cash flows. The only year that was the exception came in 2021. In their most recent fiscal year, their free cash flows have supported their dividend. While they've maintained a high dividend payout ratio throughout this time, we learned that the company is strongly cash flow generative relative to their debt, so this may not be as much of a concern as it would be for a more indebted business. While this is a snapshot of their last 5 years of performance and it's no guarantee for the future, it looks like Fastenal can currently support their dividends using their cash flows. The big metric of them all, metric number 6, we want Fastenal's average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this provides a slight risk premium to the yield of the 10-year treasury. It may offer a reasonable starting point for a fair value of Fastenal. Fastenal currently has about a $31 billion total enterprise value. This takes into account both their market cap and their net debt position. It gives a perspective of Fastenal similar to Fastenal being a private company. In their last 5 years, we learned the business produced $3.4 billion in free cash flow, meaning Fastenal produces about $683 million of free cash flow in an average year. When we divide that by their $31 billion total enterprise value, that gives us about a 2.1% average free cash flow to enterprise value yield. The company has produced nearly $928 million of free cash flow in their last 12 months. To get a current yield for the business, when we divide that by their $31 billion total enterprise value, that gives us about a 2.9% current free cash flow to enterprise value yield. Both of these are coming in below the yield of the 10-year treasury. They're below that risk premium we'd be seeking as well, meaning that all the way at the end, our first and only X of the day is coming in here for Fastenal. Just because this is the case doesn't mean you're going to throw this business out. This analysis is not financial advice. It's not a buy or sell recommendation of any security. Stick around for our DCF model to come to a more concrete estimate of Fastenal's fair intrinsic value. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Fastenal, which takes us on to using a discounted cash flow model to come to an estimate of Fastenal's fair intrinsic value. A DCF model is based off the predictability of a company's free cash flows. It's like any model in any discipline, its outputs are sensitive to its inputs. We're starting with Fastenal's current free cash flows and using historical growth assumptions to project these into the future. It's up to you to figure out if these are accurate and applicable going forward. Assuming Fastenal grows their free cash flows at 8% annually for the next 10 years, then assuming this growth is cut in half for the 10 years from there and they only grow at 4% annually, if we add in the company's tangible book value, which gives us an estimate of their net worth, and if we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments, in addition to his margin of safety requirements. From today's valuations, an estimate of Fastenal's fair intrinsic value is only around $22.50 per share. Their current stock price would be cut by more than half to reach this fair value. There are key points to keep in mind. Fastenal has had a very high degree of business predictability in its past. This is no guarantee for the future, as this could change. Due to a long history of share buybacks, there are accounting reasons why their tangible book value may be understated. That could impact the assumptions we used. Also, this 15% discount rate would be including the company's dividends. We would not be doubly counting their 2.4% dividend yield. Most importantly, this analysis is not a buy or sell recommendation of any security. It's not financial advice. Before considering any investment decision, consult with your financial advisor. In just a moment, we'll give our final rating to Fastenal, but we have to address something first. What are the qualitative aspects of the business? Starting with the qualitative factors supporting a potential long thesis. Number 1, despite serving cyclical end markets, Fastenal's business model generates strong free cash flow throughout the cycle. Fastenal is likely to continue to use its cash flow to fund a shareholder-friendly capital allocation strategy. Number 2, Fastenal can capitalize on its national scale, broad product portfolio, and inventory management services to take market share from smaller and less capable distributors. Number Number 3, vending and on-site programs should provide a long growth runway for Fastenal. Then for the qualitative factors supporting a potential short thesis. Number 1, once a primary growth driver, store count has declined by over 20% since its 2013 peak, as market saturation and e-commerce make new stores a less viable growth strategy. Number 2, Amazon Business could disrupt the industrial distribution industry, taking market share and pressuring margins. Number 3, Fastenal could continue to face gross margin headwinds as non-fastener sales, national accounts, and on-site programs become a larger part of its business. A continued mix shift toward non-fasteners could also dilute the firm's differentiation. There you have it for a balanced perspective on some of the qualitative factors for the business. Now it's time to give our rating. In analyzing Fastenal, stock ticker FAST, FAST, we learned the company earns significantly above average returns on capital of nearly 33% in a given year in the last 5 years. They've experienced strong revenue, earnings, and free cash flow growth and have had minimal shareholder dilution. Their free cash flows easily support their net debt position. However, on both a current and an average basis of their free cash flow to their enterprise value yield, those were both coming in below the yield of the 10-year treasury. Fastenal supported a growing dividend in 4 of the last 5 years. They even paid a special dividend in 2020. The company does have a pretty high dividend payout ratio. That's something to keep an eye on if you're interested in the company for its dividends. It's worth reiterating this analysis is not financial advice. Combining the factors of our analysis together, Fastenal looks like a very strong candidate for further research. Performing our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions from today's valuations of Fastenal, if you are seeking a 15% rate of return, an estimate of Fastenal's fair intrinsic value is only around $22.50 per share. The company was last at those levels in December of 2017. You'd want to be patient as you dig in and research more about the company. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Fastenal with me, and have a great day.